Well, hello everyone, and welcome out to your RBA rate decision. On behalf of Maverick Currencies, I'm Corey Halliday. Nice to be with you, all of you, and let's jump into it. So, the RBA rate statement is not a foregone conclusion. There is some debate about what they're going to do exactly. So, the expectation, the consensus, most people feel that they're going to keep rates unchanged. And that's been the case the last couple of meetings. There is a little bit of pushback on that. There's certainly, I would say that not the majority, the minority, but they feel like a 25 basis point rate hike is going to happen. So a little bit of indecision here. If they were to raise by 25 basis points, that would move the rate to 3.85%. Again, not the majority, the minority feel that that's going to happen. But the reason that's interesting is usually, generally speaking, the rate part of it is pretty standard and pretty expected. Like if they expect 3.6, you get 3.6. And it's usually the statement that is a bigger market mover because the rate actually moving has already been priced in. People already know, they've already forecasted that they're going to raise. Like in the US, for example, the US is expected to raise by 25 basis points. They've been on record, the messages have been that way, and so on and so forth. The equity markets are up, so there's not a huge maybe risk to them feeling like they shouldn't do that, so on. Even some of the banking crisis and some of the issues in the US, well, those seem to be getting resolved. JP Morgan took over First Republic this morning and so forth. So anyway, make a long story short, usually the rate is pretty obvious and it's the statement so that you can price in the future. It's, oh, well, here's what they're saying. This is what we didn't know, and now we start to know that they're likely to raise in the future, whatever that statement says. Again, this one's interesting because the actual rate matters a bit. If it comes in at 3.6, those people that were expecting a 3.85 are disappointed, positioned incorrectly. They have to close their trades. They were expecting a hawkish central bank. They got a dovish. The Aussie would likely move down. If they were to raise, the group that, which is the majority that didn't think they were going to raise, is now caught off guard. The Aussie's likely to rebound. Usually the rate number doesn't matter. Oddly, I think this time it does a little bit because there's a bit of an offsides trade, a bit of a, hey, we were positioned for this, for them not to raise, and they did. Now we need to adjust, and the market needs to price that in and so forth. So the Aussie has been rallying it the last couple of days leading up to this. I mean, the overall trend, this is the daily chart of the Aussie versus all other currencies, clearly in a long sustained downward trend. I mean, the trend has been lower, but we've bounced the last couple of days, and the FX markets have been somewhat choppy. Euro, which has been the strongest, has been weak the past couple of days, and those are almost polar opposites, where the euro is upward trending the last few months, the Aussie was downward trending. The Aussie bounced the last couple of days, the euro fell the last couple of days. They're really opposites that way, so you could look at Euro Aussie as a potential pair and say, since they're moving in opposite directions, if we feel bullish about the Aussie, we short Euro Aussie. If we feel bearish about the Aussie, we go long Euro Aussie. You could play it in that fashion. A lot of these others, I mean, as per usual, the Kiwi is more positively correlated to the Aussie. They're both in big sustained downtrends, but bouncing the last couple of days. CAD has been better than those in terms of a risk-on currency. It has held up relatively well the past few months, even as Aussie and Kiwi were trending lower. Euro Aussie, again, I think is kind of interesting as a pairing because for no other reason, they're moving opposite to each other. And that's kind of an interesting dynamic where there's that inverse correlation. So if we just go into Euro Aussie, couple of things that I would note. One being that we had a real exhaustion high, a true kind of exhaustion signal at the highs that it's been falling off of. This is a counter trend. If you're trying to short Euro Aussie, you're doing it counter trend, but at least you know that the race began back here and we seem to have hit a finish line of sorts. So we're likely in a bit more of a correction. I tend to think that Euro Aussie has a little bit more to correct to the downside over the next few days, next week or two. Um, we talked about this in the trading room Wednesday, the midweek update. I really have a risk on outlook. I mentioned this, I'm bullish on stocks, etc. I'm not going to reiterate everything, but you can watch the video on our website. So if you watch that, we talked about how stocks and risk was likely to go up. Well, that's happening over the past week. If you look at the most risk off things like, well, Japanese yen is the single worst currency, and it's definitely a risk off. It should be going down sharply as the equity markets and risk is being taken. The US dollar is not as correlated to that right now for whatever reason. The Aussie's been bouncing the past couple of days, and I frankly didn't expect that. I would expected that the yen, the Swiss franc, the US dollar, that they would trend a bit lower the last few days. Um, True on 2 out of 3, not true on US dollar. So I don't know what to make of the US dollar. And I think what I'm making of it is it just isn't something that I feel comfortable that I've got my arms around. When something is doing what you don't anticipate it should be doing in the environment you're operating in. So if we check all the boxes, I mean, did I think yen would go down? Yes. Did I think that some of these that were really strong, euro, Swiss franc, should give back some ground? Yes. Did I think Kiwi and Aussie and CAD would bounce? Yes. Really, US dollar is the one where I thought it would go down, and it's going up instead. So why trade it? It's the one that's giving me the wrong answer, and I just don't know what to make of that. I'm not sure I can really wrap my arms around it and go, here's why the US dollar is doing what it's doing, and it makes perfect sense, and it should continue to go this way, or it should reverse and go. I just don't know. I'm not sure exactly what's in play there, so I'll just leave that one alone. And that's why, for me, I'm just kind of avoiding the US dollar pairing. I'm more interested in Euro Aussie, and specifically a little bit more interested in it on the short side. So if we come into a 12-hour, still kind of an uptrend exhaustion that's falling off, 4-hour, you're getting a deeper pullback. 1 hour, you're now in a downtrend. So I need, one of my rules is that at whatever time frame I'm trading, I need the next longer time frame to agree with my trade. And this one doesn't really, and this one doesn't, and this one doesn't in terms of getting short. None of those really had big downward trends or anything working on the bearish side. The 1 hour does. We're in a downtrend on the hourly, but I need to trade one of these shorter time periods because I need the next longer time period to agree. And I finally found the time frame that does. So I'm more likely to trade. I kind of skip the 30-minute usually and go more towards a 15-minute, maybe a 30-minute on occasion. 5-minute is just a little too rapid for me. But I'd be somewhere in this 15-minute to 30-minute range, being that the 1 hour is bearish. I can't really trade the 1 hour because the 4 hour is not really bearish yet, right? It's still above its 50 period MA and so on. So that's just a personal rule that really gets me in the right frame of reference, because if I start shorting things that are really strong, it's probably not going to be the best approach long term. Instead, I want to find things that are working with the trends, with the momentum and such. So this 30-minute, if the 1 hour is bearish, this 30-minute is kind of in a little symmetrical triangle of sorts. You have a little bit of a wedging formation happening where it could break either way. Just kind of a coiled spring, if you will. You've got declining highs, you've got rising lows, and they call it a symmetrical triangle or a volatility compression chart pattern. Volatility compression, because if you think about volatility, you can compare peaks and valleys, but in this type of pattern, you're losing volatility. The highs are getting lower, but the lows are getting higher. So in other words, price is moving a lot, then a medium amount, then a low amount, then a tiny amount. It's not going anywhere. Larger waves followed by smaller waves. And volatility is mean reverting. When you get to the apex of this triangle, usually there's a big break, and it can go this way or it could go big break that way, but ultimately some sort of breakout looms. And of course, we're coming right into the RBA, so I'm going to be a little more interested in possibly shorting right here. Now, if we were to short, you'd basically have your short order ready, and I'm going to have it on my other screen, but I might have a short limit, pull up a short order, and usually the way I would do this is say, I'm only willing to short it, and I'd look at the price, and I'd probably pick a price that's a little below and say, okay, well, I might be willing to short it only above 65.50, right? It's at 65.62. Put my short order at 165.50. Excuse me. What that allows me to do is, and that's my limit price, what that allows me to do is just quickly hit the transmit and get it filled. If the price is moving rapidly, as long as I can get short at 165.50 or higher, by the way, if I transmit that order and it's trading at 165.62, it'll fill at 165.62. So I'll still get the better price, but basically I'm determining how low I'm willing to go, and it sort of acts like a market order, meaning it just gets filled automatically at current prices as long as it's above that price. I really wouldn't put a lot of risk behind this. For me, you could almost just really keep a tight leash on this, and you might have your buyback stop up here at like 165, maybe even 81 or something like that, and you're only risking 31 pips or so. Now it'd be a pretty quick trade, because as we break to the downside, you're just going to take profits pretty quickly, maybe down towards these lows. So we're coming right into the announcement right as we speak. One of the things that we watch for is volatility. You should see this chart jump. It should really spike up or down to tell us that was an energy move. It's almost like you can see the reaction. And if that move spikes more to the downside, I'll be more likely to hit that transmit, but we'll see. Right now, not too much happening. So we're coming right into the half hour, just a couple of seconds away. You can see it kind of rallying up before the announcement, and there's a jump. Now it jumped up on the announcement, so that makes you think that they did not raise. And there, okay, a delayed reaction. They did raise. Apparently, that was a volatile spike there. It moved a massive amount in a short period of time. So I was getting ready to go look at the number, and then you could see the energy. Now, does this have plenty of energy? You bet it does. The problem is now we've got to reassess, because it was such an energy move. Really, we're only going to get short I don't want to try to hang out here all the way back up where it was. It shouldn't go back that far. We could basically break this candle into fourths and say, okay, here's your 4 sections, and right about there would be where I'd consider getting short at about 165.05. Now, if we did that, we'd probably put a stop up here at 165.40 something, and it will change things a bit. Now you'd be risking about 38 pips, a little bit more. But this is something we'll have to consider. I'm guessing they did hike. You could just see a big burst. So let's refresh Forex Factory. And sure enough, there you go. 3.85. You see how there was debate as to what they were going to do. And you knew with the reaction, I didn't need to see the number. When I saw, it was kind of spiking around, and I thought initially it jumped up about 5 or so pips. I thought, well, it probably didn't raise, not too much of a react. And then bam, you could see it. I mean, it happened in 1 second. There were about a 80 pip drop or whatever it was. So we went from 165.60 something to 165. Yeah, it was about 100 pips. About 100 pips in a flash. I mean, that's energy. That's power. Does it go lower? Probably so, because like we talked about, it now has to price this in. And there was real debate, and there was really two sides, and there was really a lack of true knowledge as to what the Bank of Australia was going to do. And so by deciding to raise, they really caught the majority flat-footed there. And, you can see it definitely was not priced in. So we were a little, it was just going to be hard. If you weren't in that trade at the moment it happened, this is one of those events where there just probably isn't anything for us to do immediately right here, right now. Were we hunting in the right spot? Absolutely. The idea of being short Euro Aussie, in this case, this is one situation where you could have, would have, should have gotten short before the announcement. Is that a lot higher risk? You bet it is. Is it a lot higher reward? You bet it is, right? This one would have worked out. We certainly had the right idea, the right thought process, the right analysis. We were hunting in the right spot. We had it all. We just didn't have the trade. So we needed a little bit more of a pop, but not 100 pips, pop 20 or 30. Pop and show us energy, and we could jump in still. This one just went a bit too far too fast, and it was just hard to catch. So certainly made more difficult in the moment with a live class, but I don't think I would have been able to get into anything anyway. So I think this is one where we got to just chalk it up as, well, we got to wait for the next setup, the next opportunity. Shorting down here, it's just tough. I mean, when something has moved that far, how do you manage it? Where do you put your stop loss? I mean, this thing will probably bounce up to here. If you had a stop loss there of 30 pips away, it's probably going to bounce there and for no reason, just market choppiness, just noise. Might do it in the next 3 minutes or something. So because there's no place to really put your stop, there's no way to really trade this. We don't have a setup that, we could just put our stop loss right here. It's a perfect spot up above resist. We don't have all that. So I think this is a case where, again, we had the right ideas, but just a very, very fast moving market. Good question. Does this mean that the RBA has now hit its terminal rate, that it's going to stay right here? I think it is going to stay here most likely for a time. I don't know. Obviously, nobody knows exactly what the future holds, but I don't think that this is one of many. That's not what they're forecasting anyway. Can they go a little higher and get into the fours? Yeah, if inflation stays sticky, that's what these central banks are battling. So it's going to be dictated based off of inflation. I'm personally not really surprised that this number came in different than forecast because even though it wasn't the majority that thought that, there was a real debate happening, like we talked about early on. So, anyway, we'll leave it there. Thanks again, everyone, for joining us tonight. Have a great rest of your evening. And we will be back, well, I'll be back with you live Wednesday for the currency midweek. Have a great rest of your night. Goodbye, everyone.